Debt Market Update, January 2020. The 10-year benchmark G-Sec yield ended the month of January 2020 at 6.61%, up 5 basis points over the previous month end. Average interbank liquidity continued to remain in surplus for the month due to high central government spending, forex purchases by RBI, and soft credit growth vis-a-vis deposit growth. Corporate credit spreads over G-Sec yields increased sharply by 22 basis points during the month. Monetary Policy Committee (MPC) in its February 2020 meeting unanimously voted in favor of keeping the policy repo rate unchanged at 5.15% and maintaining an accommodative stance. The reverse repo rate and cash reserve ratio (CRR) remains unchanged at 4.9% and 4% respectively. RBI revised its inflation forecast upward, with new projected inflation being 6.5% for Q4 FY20, 5.4% to 5% for H1 FY21, and 3.2% for Q3 FY21, as against forecast of 5.1 to 4.7% and 4 to 3.8% in H2 FY20 and H1 FY21 respectively in December 2019 policy. RBI estimates GDP growth at 6% in FY21, up from 5% expected in FY20. In a significant step, RBI announced conducting long-term repo operations of 1 year and 3 years, up to a total amount of INR 1 lakh crore at the repo rate against the G-Sec holding. This should improve and smoothen the liquidity for banks and support credit growth. Macroeconomic update. After rising 92 basis points in November 2019, Consumer Price Index (CPI) rose further to 7.35% in December 2019, up 181 basis points month-on-month. The increase was largely due to significant increase in food inflation, mainly vegetables, pulses and meat, which surged 12.2% from 8.7% a month ago. The supply of vegetables, especially onions, has improved in January 2020 and prices have eased to a certain extent. Fuel inflation also inched up, mainly due to low base effect. The core CPI softened due to lower clothing and weaker rural education and healthcare inflation. Wholesale Price Index also rose to 2.6% in December 2019 from 0.6% a month ago, driven by increase in food articles. Food articles inflation stood at 11.5% year-on-year for December 2019, up from 7.5% a month ago. Inflation of manufactured products continued to contract year-on-year. IIP for the month of November 2019 turned slightly positive at 1.8% after contracting for previous 3 months. The uptick was broad-based, with mining and manufacturing both growing by 1.7% and 2.7% respectively, but electricity contracted by 5%. By usage, the intermediate goods and consumer goods increased by 17% and 0.6% respectively. Pace of contraction in primary and capital goods also declined to negative 0.3% and negative 8.6% respectively. The growth of core industries turned positive after 4 months and registered increase of 1.3% in December 2019 on back of healthy growth in fertilizers, cement and coal. The pace of contraction in electricity generation also reduced. India's trade deficit for December 2019 fell to $11.3 billion, down approximately $900 million, primarily on account of fall in net imports, excluding oil and gold. Excluding oil and gold, the trade deficit fell due to lower imports of engineering, electronics, and ores and minerals, along with strong export growth in electronics goods. On net basis, the oil as well as gold imports remained largely stable. INR was flat against USD and closed at 71.4. In the Union Budget 2020-21, government revised its fiscal deficit target to 3.8% for FY20 RE and kept it at 3.5% for FY21 BE. The revision in FY20 was on account of weak corporate tax and GST collections along with lower divestments receipts. In our opinion, the revised estimates are still slightly ambitious. On this high base for FY21 BE, growth in tax revenue seems reasonable, but target of non-tax revenue and divestments seems aggressive. For our detailed view on the budget, refer to our published note, Life After Budget, available on the website www.hdfcfund.com. Most commodity prices softened, driven by concern over China's growth as coronavirus spreads rapidly. During the month, Brent crude prices fell by approximately 12% and closed at $58 per barrel. Gold prices rose on back of safe haven demand. Outlook. The MPC's decision of keeping the policy rate unchanged and maintaining an accommodative stance as long as it is necessary to revive growth, while ensuring that inflation remains within the target, was in line with expectations. The announcements of conduct of LTROs, long-term repo operation, of 1 and 3 years duration at repo rate came as a positive surprise and led to yields of government bonds of up to 5 years maturity rallying by 15 to 25 basis points. At the longer end, GSEC yields rallied between 5 to 10 basis points. Thus, GSEC yield curve steepened. This also validates our view, which we have been highlighting for some time now, that the short to medium end of the yield curve offers better risk-adjusted returns. Going forward, given that RBI is expecting inflation to be below target only after 9 months amid some sign of pickup in economic activities, any future rate action by RBI is likely to be data dependent. Further, with regard to yields at the longer end, we maintain our view that opposing forces are at play. Easing stance of major global central banks, ample interbanking liquidity, steepness of yield curve, no additional market borrowing for FY20, and weak credit growth favor lower yields. On the other hand, aggressive revenue assumptions leading to risk of fiscal slippage for FY21, excess statutory liquidity ratio investments within banking system, high near-term headline inflation, possible bottoming out of growth, etc. are likely to impact yields adversely. In view of the above, yields at the longer end of the curve are likely to trade within a range in foreseeable future. Considering the aforesaid factors, we maintain our view that the short to medium end of the yield curve offers better risk-adjusted returns. Hence, we continue to recommend investment in short to medium duration debt funds. Further, the prevailing high credit spreads also creates a favorable risk-rewards opportunity in select pockets, in our opinion. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.